taking public comment through Zoom, through Zoom, so
Ah.
they have to be in attendance.
Oh, I forgot that. A little refinement. Thank you for clarifying. Old business, we don't have any, fortunately. So we're on item 2 of the agenda, which is an informational item on internal audit. Just one quick comment I want to make before we get to this item is that most people in this room were maybe at the city council meeting, but Chelsea and yeah.
I think we may have forgot to unmute in the beginning, so
Oh,
wanna
well, that's okay.
roll call.
We'll just start now.
It's fine. Okay, it's fine.
Just keep going.
Okay.
So yeah, my comment was the great internal audit presentation by Christina and Chelsea. I thought it went really well at city council and you know, just want to make that comment that you guys all did a great job and glad to be part of the team. So today we've got received internal audit, fraud and fraud, wasted abuse, as well as a programs update. Turn it over to staff and then
We have Colleen on.
Boss Adams and Colleen.
Yeah,
It's all yours.
Boss Adams.
All right, good afternoon, everyone. Good to see you again. I'll go ahead and share the status report just so you can take a look at it. I know that it's in your packet. All right. So we have kind of an interesting status report for this quarter because we're crossing fiscal years. So I'm going to go through the 23-24 internal audit program. We're complete in terms of the risk assessment. As you mentioned, I presented just a couple weeks ago to council. And then our ongoing internal audit services for last fiscal year is also complete. So we have our citywide policy review project that is inventorying and doing a gap analysis. We're just about done with that project. We provided a draft report just last week to staff, and they're going through their review. We'll have a couple of meetings to finalize, and that will be presented at your next quarterly meeting in October. In the meantime, as the chair mentioned, we have an approved audit program for next fiscal or the current fiscal year. And so we're getting started on a couple of projects, the special revenue fund process review and the recommendation validation process establishment. Those two projects, we're just developing the project plans and getting started, kicking those off. Our ongoing internal audit services, as usual, is moving along. And then we won't get started with the grants management internal controls review until January. With respect to the fraud, waste, and abuse hotline, this quarter we received 4 total complaints. 3 were related to employment matters and sent over to HR. And then 1 was not related to the city, and so it was closed. So lifetime total, we have received 22 reports since the hotline was established about 2 years ago. And 4 of those continue to be open in terms of being reviewed by ourselves and staff. Any questions for me?
It sounds like all those reports that are open are recent ones, correct?
Yes, and that's usually what happens because they'll get closed out in typically a short period of time as we figure out how to respond to them.
Sure, thanks.
I think I've asked this question before, but you said 3 out of the 4 went to HR?
Mm-hmm.
Went to HR?
Yes.
What will HR do?
So typically, they're related to issues maybe around something like employee compensation or staff and manager challenges or staff to staff things that are really just meant for human resources. So HR then determines how to respond and address the incident, lets us know what they did, and then we'll close out the report.
Okay.
Generally speaking, did you see a decline on the number of reports?
I would say we're pretty steady. So if we think about 22 reports over 2 years, that's, I would say, a pretty consistent amount per quarter. I don't think, I mean, we've had a couple of quarters where we've had not very much activity at all. So I don't think that the current amount of activity is anything out of the ordinary for you all.
I had one question. Are most of these reports coming in from inside, or are they, are these like whistleblower complaints from outside?
I'm so sorry, you said, are the reports coming from the outside? Is that what the question was?
Yeah. Is it like the public, are there instances where the public files of fraud?
Yeah, so
Fraud.
there are instances where the public will report things either observed during council meetings or things that they have concerns about. I would say the majority of complaints or reports to the hotline are typically city employees. And that's the purpose of the hotline ultimately.
So out of the 4 that are open, are you at liberty to tell me how many are from inside?
I actually don't know the answer to that. We know on the report that 2 of the employment matters that were received this quarter are still under review. So we know it's at least 2 of 4. But I have not been in the system to check the details of those that are open.
Okay. Maybe we'll hear about it next.
Yeah.
To me, it sounds like a very positive report and program. I'm still getting familiar with it. Is there, maybe it's been addressed in previous meetings, but is there a expectation of a positive, like if 22 is normal and there's not been anything discovered or uncovered that was extremely unpleasant, do other cities ever take advantage of that by summarizing it and putting it somewhere? Or maybe we're already doing that as a city. I don't know.
Well, we certainly could report on annual statistics or something like that. I think I mentioned this when I presented to council that it's having the preventative control of a hotline is the most important in terms of internal audit and making sure that we have that perception that there is the hotline out there. That helps to deter quite a bit of fraud or unethical behavior. People say sunlight is the best disinfectant, right? And so the more information that we share about what the city's processes are and how we deal with these things, the better off the city will be from an ethics standpoint. But I wouldn't necessarily recommend putting out like an annual report on fraud hotline activity. That's not something that I've seen a lot. And I think we would add a lot more value by focusing on that performance and controls element.
Okay, great, thanks. So unless there's anything else, thank you very much. We will, let's see, sometimes, yeah, I think that's your item, so you're welcome to stay, but otherwise, thanks very much, and
And so if you guys don't have any comments, I guess just gonna move on, essentially consolidated the 2.
yeah, I was thinking it's an information item, so it's a great question. Maybe you can clarify, what do we do with information items? We just talk about them and
I think you would typically break it up into the questions, public comment, and then go to your own comments.
oh, you're saying we should still take public comments?
There is no public here.
Okay,
And if you don't have anything to add to your comments.
sure.
We could also ask the chair to receive the report. So that would be an action bring the table.
What do you think is best practice? Should we be receiving the report, or you can ask the chair? Is that what you say? Okay, that's very efficient. Okay. All right, so we don't have any, so the public's been given a chance. There's nobody out there. We don't have any more comments, and I like the city manager's suggestion. I hereby say we've received the report. Very good. So, thank you again. You're welcome
Thanks,
to stay.
everyone. Take care.
Sure. Thank you.
Thanks, Doug.
Our next agenda item is another informational item, but this one's on OPEB and pension, one of our favorite recurring items. I know staff has oftentimes something to say, or do we want to hand it over immediately to PARS and US Bank?
I think we can hand it over. I think Dennis, Rodran, and Jennifer, should be taking it.
Well, welcome Dennis and Jennifer
Hi, good
Thank you.
afternoon, everyone.
and
I
Will.
think- Perfect. Will, are you going to be sharing your screen, Will?
Yes, please allow me one moment. Alrighty.
Thank you, and good afternoon, everyone, staff and members of the committee. Once again, my name is Jennifer Meza with PARS, Will Rogers from PARS, and also Dennis Mullins from PARS. On my end, we'll go to the contact page. We do have an update for you. The next slide, Will. I think, do we not have a contacts page, Will, on the front?
Not on this abbreviated version, no.
Okay, so let's just go directly to Dennis's presentation. He does have a contacts page on his slide. One more. Perfect. I did want to relay some information to staff and to the committee. The last maybe 8 or plus years, we've had Rick Rosenthal presenting to the committee and to staff. Rick has notified us that he has, parted ways with US Bank. Dennis Mullins will be now the city's portfolio manager. So Dennis was here during the last meeting, and he is going to be presenting to you going forward at this time. Does anybody have any questions regarding that change or any discussion that we wanted to do before I turn it over to Dennis to do the investment outlook?
I do have a question. I mean, if you give me a chance, I'll always have a question, so, but sorry. There's this other organization that I think Rick joined. It was PFIM or, sorry if I've got the wrong initials. And I see Dennis is part of US Bank, maybe not PF. Well, I guess it is PFM. So I guess it's the same sub portfolio organization. It's just Rick is no longer direct contact portfolio.
That is correct. Yeah. US Bank purchased PFM Asset Management a couple of years ago and moved all of the institutional asset management functions out of the US Bank Trust Department and into PFM Asset Management, which is a wholly owned subsidiary of US Bank.
Okay.
Yeah.
Right. Thank you. I know I've asked that before, but it's clear right now. Thank you.
All right.
All right, perfect. And that was just the update on the administrative side that I wanted to provide. Otherwise, I'll turn it over to Dennis to discuss the investments.
Thank you. Will, let's go forward to the first page on OPEB. One more. There we go. I'm going to take just a moment to review your OPEB portfolio and then your pension pre-funding portfolio. They are both invested in the same manner, so I don't need to repeat a lot of information about them. I want to give you an overview of how they're invested, talk a little bit about the mechanics of the process, just so that it makes sense to you, and then also talk about the returns, and then finish up with a little bit about our outlook. Before I get started, how much time should I take to keep you on schedule?
I'd say maybe 10 minutes. I think Q&A tends to be the most exciting part, Dennis, but we're
Okay.
open.
Okay, very good. Your OPEB portfolio is shown here on page 5 that's in front of you now. It is roughly 65% in stocks and the remainder in fixed income and other assets. Right now, fixed income, some real estate, and then some cash. The total value of the portfolio as of June 30 is $37.967 million there. Let's go ahead to the next page, Will. The 35% or so of your portfolio that is in fixed income is itself 80%, 82% in high quality investment grade. It's about 80-20 investment grade, 20% or so in high yield or junk bonds. Mutual funds and exchange traded funds are a great way to invest in non-investment grade bonds. The spread between yields on investment grade and non-investment grade right now is about 3 percentage points. So investment grade bonds are yielding about 5.5% right now. High yield bonds are yielding about 8.5%. The beauty of using mutual funds or exchange traded funds to invest in that slice of the market is that we diversify away the concerns about default risk. These are stressed investors by definition. And so we're able to, again, diversify away that risk. Let's go to the next page, please. The equity portion of your portfolio, this is the engine of the portfolio. This is where we make our money, and it's where we take our risk. We allocate this, we split this up. It's heavily diversified. So we've got large cap US stocks, mid cap US stocks, small cap US stocks, developed foreign markets, which are the benchmark for this sector is Europe, Australia, and Far East. And so that's primarily Japan, France, Germany, and the UK. And then emerging markets is a small portion of the portfolio. Emerging markets are primarily China, Brazil, India, Latin America. Okay, let's go to the next page, please. If we look through the mutual funds and exchange traded funds that we hold in your OPEB portfolio, and again, the same for the pension pre-funding, you can see the top 10 holdings in the upper left-hand side. Now, no surprises here. We are currently indexing your large cap domestic equity. That's the largest portion of the portfolio. And so the top 10 stocks in your portfolio are the top 10 stocks in the S&P 500 at June 30. You can see the really good rates of returns in the 52-week column, led by NVIDIA and then Amazon, Microsoft, again, all of the big tech names that have dominated the S&P 500 recently. Some of the equity characteristics are shown in the upper right-hand table. You can see the PE, NTM is next 12 months, PE, LTM is last 12 months. And then you can see the recent historic EPS growth and the estimated 3 to 5 year EPS growth. So get a flavor for the stocks that are in the funds that we're holding for your portfolio. Let's go ahead to the next slide. And I'm going through admittedly very quickly here to keep us on schedule, but certainly we'll take any questions when we're finished here. You have a customized benchmark that's spelled out in right here. It matches your investment policy, and I want to begin a discussion with you about updating your investment policy. This is the benchmark we've been using. We'll continue to use it as long as you want, but there's a little bit of a mismatch going on right now. For instance, we don't have any commodities in the portfolio, but we've got 2% of the target benchmark is in the GSCI, which is the Goldman Sachs Commodity Index. We use the global aggregate, Bloomberg Barclays Global Ag, for the fixed income portion of the portfolio. We don't have any non-US fixed income in the portfolio. A little bit of a mismatch there. And then the last thing, that MSCI All Cap World Free Index is a global stock index, and that's a good idea. We have a global stock presence. But your investment policy limits you to 20% non-US stocks. And so that's a bit of a mismatch. So we would like to, I guess, just toss the idea out there that we would like to maybe sit down with you, work between meetings on updating your custom benchmark so that it more closely matches what we're doing with the portfolios.
I think that's very timely because if I'm not mistaken, we've got on our agenda for our next meeting in October to look at the investment policy. So I guess October would be ideal for us to, after you've had this internal discussion with the city. But what you're saying makes perfect sense. To me, I'm not sure we want a personal view. Commodities, there's a role for a balanced portfolio, but I'm not that sure that at the city municipal level, it's worth that kind of, maybe you could have the discussion internally of what would trigger ever investing in commodities at the city level. And I can, maybe you guys will come back and say that's an item that doesn't really need to be there because you're really looking at fixed income and equities primarily as driving the conservative portfolio goals that the city has.
Yeah, well said. Okay, I'll put that down, and we'll at the conclusion of this meeting, we'll reach out and start talking about having that conversation. Super. So that we can come to the October meeting with maybe some recommendations. Let's go to the next slide, please, Will. Investment returns for your OPEB, and these are identical to the pension pre-funding, so I really, again, don't need to repeat everything. So you can see the total value here as of June 30. For the month, 1.11% on the second line, which is total portfolio net of fees. It was a good month. Anytime we can see more than 1% in a month, that's an annualized return in excess of 12%. We'll take it. For the 3 months, April, May, June, 0.44%. For the year-to-date period, first 6 months of the year, 6.35%. Again, a great quarter that annualizes, over 24% a year. So it's been a very strong start to 2024, surprisingly so, because if you go back to the beginning of the year and read everybody's outlook, pretty much everybody in this business was talking about a pending recession that would force the Fed to cut interest rates. And yet we've seen very strong economic growth this year with very strong employment numbers. So good, surprisingly strong start to the year. For the trailing year, 13.65. So that's July 1 of 23 to June 30 of 24, 13.65. Certainly an above trend return. Again, great year to put in the books. Sure helps out with that funding status. For 3 years, 1.35. That's a low number. What that means, though, is that we've recovered all of the losses from 2022 and made some money, to boot. So the losses from 2022, which was a year where the stock market was down 18%, the bond market was down 11%. And so for a 60-40 portfolio, that was a devastating year. It was the only year of my 40-year career where stocks and bonds have been down in the same calendar year. Usually we expect stocks and bonds to offset each other a little bit and mitigate the volatility, add a little income. They certainly didn't do that in 2022. So we've recovered the losses from 2022, all thanks to the stock market. The bond markets have not recovered their losses. If you look in that 3-year column and go down through the stock indexes, you'll see mostly positive returns. Small caps are still negative. Emerging markets are still negative for 3 years. But then if you look down at fixed income, you see negative numbers. So the bond markets have not recovered their losses yet. And then for 5 years, 6.34. So we think this type of a 65-35 portfolio will probably produce long-term returns in that 6.5% to 7% range. So your 5-year results are actually indicative of what we expect out of these portfolios for the long term.
Hey, Dennis, maybe why don't we focus a bit on this page, and apologize if I'm interrupting your narrative flow, but it's one of the key pages. So we would have to come back anyways. This way we don't have to do the slide. I think you mentioned that the pension is got similar results, and I did look at that, and there's a similar page to this back in the 20s or so. And the pension actually did better in the 5-year period, which was interesting to me. And I think it's because there were probably inflows coming into the pension during that 5 years. Okay, so the timing of the inflows caused some performance change over time. I guess what I was more concerned with, I guess, is you touched on it, so maybe it's worth re-emphasizing the expectation of the 6.5% to 7%. If I look at the pension performance, it's showing 7% over the 5-year period, which to me seems a nice number. When you go in, you end up using this number for a lot of things. So maybe in October, after we've had some sort of, you guys have had a chance to think some more, you'll probably be able to tell us what the expectation would be if we follow a certain index. And to me, the 7% doesn't seem unreasonable based on a long-term 65-35, 70-30 ratio. I wanted to point out that there are some differences in performance on these two. And I guess maybe you would expect that over time because you don't, or are you like maybe making transactions simultaneously in future? Or are there inflows coming in still to either of these portfolios?
I can answer that second question. We don't anticipate there to be inflows coming into either of these portfolios in the near future.
Why is that?
Because of the current budget situation, we have not programmed any transfers in. So right now, for the OPEB items, we pay the annual amount that's due for the actual expenses and what the actuary is recommending that we spend, but not over and above. And then the pension trust doesn't have an annual contribution that's necessary. We had a plan set in place in terms of transfers in. And we got almost to, I think we were short about 2 million, but given the budget situation, we put that on hold to do the last transfer. And plus it's been doing better than we anticipated in terms of the dollars that are.
But that there was a 2 million transfer out of this.
No, for,
Actually, I was gonna touch on that on the following item, but we did transfer, decrease the OPEB account by $1.2 million. And that was to cover those expenses related to fiscal year 22-20. So that was a council budget. So then we had abundance of cash at this point. We didn't have your need to pull it out immediately. But we do have a window in which we can withdraw. And that was, we were closing that window at the tail end of June, fiscal year 23-24. So we made that withdrawal to cover that council approved withdrawal from 22-20.
That's what you're saying will not happen again, or likely will not.
so there's two pieces. So that's coming out. That we use that as part of our budget balancing strategy. So we're leaving the general fund of those costs. So that transfer out, we wouldn't anticipate unless the fund gets in a better position. We're in need of some offsetting expenses for the general fund. We would come to council, we need to get that pre-approved if we were going to use. But I was speaking more of influxes of money coming in. So additional dollars to fund the pension or the OPEB. I don't anticipate any transfer in or dollars coming in the foreseeable future.
That would be coming from our general checking or CHAM or some other cash or cash investments.
Actually, the mayor's question is very timely. Dennis and city finance staff, one of my questions was, part of this for me is when we look at the pension footnote, and that's so complicated. I get a headache even thinking about it, but we won't look at it for all kinds of assumptions that go in there. And some of it relates to how well the performance of this portfolio is doing in my layman's terms, I want to say. So there's also a set of returns that are on this very nice page that I always focus on. So I'm talking out loud here, Dennis, or anyone, but oftentimes on an individual investor perspective or in a commercial context, there's stuff like XIRR, where you're looking at ins and outs as well as the return of the portfolio, and you end up with a bit of a number that maybe is more comparable for the pension comparison. That 6.71, for example, fee adjusted number is. So Dennis, I don't know if you've seen that in your city context. Are you seeing some other additional report here that would show the 1.2 million or whatever that amount was that came out with an XIRR computation, which could well show higher than 6.7, I'm thinking, depending on the timing of those flows, right? They could have come out when the market was at a very high rate and the city benefited from that or whatever. Have you seen any other measurements besides this page that you're showing?
Yeah, what you're getting into is the actual calculation of the return number, because we have to make sure we don't get credit for contributions and we're not penalized by amounts coming out of the portfolio.
Okay.
So what we do is to adjust for those, we'll revalue the portfolio when there's a large cash flow. And then you create a sub period, and then we link those sub period returns together. So that'll prevent us from, again, being credited with growing the portfolio when you make a deposit, if that makes sense. So that's all part of the calculation.
So you're saying the 6.71 adjusted for fees is actually comparable to a geometric type of return the city's maybe been experiencing?
It is, yes, very much so. Yeah.
Great. That's the answer I want. Okay.
Yeah.
Uh,
Yeah. So, yep, go ahead.
We probably have to be sensitive to everybody's schedule. We are a bit under the gun here, but I do like this page. If there's anything else you have on this page, maybe in future, you might put a little bit of that description you just gave us verbally as a additional reading material. We don't have to necessarily focus on, but it's very helpful when we come to the pension discuss or the pension comparison discussion as how the assets are matching up with the liabilities.
Absolutely. And one of the things we do, along those lines every year is we produce expected returns for portfolios themselves.
Great.
And I'll have that in the October meeting. That's
Fantastic.
usually very helpful for actuaries when they're discounting the future liabilities to calculate the present value of future liabilities.
Great, thank you. Looking forward to October already.
Absolutely.
Is there anything else you wanted to tell us about OPEB or pension?
Well, the last thing I want to mention, and again, the pension is virtually a carbon copy of this, just a different market value. We will be changing some of the investments around. We're not married to any of the investment funds that we use in here. We manage for you as a fiduciary, which is a legal standard that requires that all decisions must be in your best interest. Specifically, that prohibits any self-dealing. So we don't benefit from any of the funds we use in here. We will be changing the look of the portfolio a little bit. We're at a market juncture. It's been a real strong first 6 months of the year, unexpectedly so. So we're reassessing the portfolio. We'll make some trades in here. The beauty of mutual funds is that they trade with no commission. So there's very little resistance to changing the portfolio. And then the last thing I want to mention about our outlook is looking out into the future, probably expect a little less out of the stock market over the next 10 years. You can see here the last 5 years, the S&P 500 has given us 15% a year. That's probably above trend, and we're expecting a little less than that going forward. At the same time, we're expecting a little more out of the bond market over the next 5 years. The last 5 years, the bond market, using the indexes here, the US aggregate is down 0.23%. That's per year for the last 5 years. Those bonds are now yielding about 5.5%, where 5 years ago they were yielding about 1%. So yields have jumped up. We've paid the price by being a bond investor. But looking forward, we're going to flip that script a little bit because you're now yielding about 5.5%. And if rates come down over the next 5 years, which is what the expectation is, we could make 5.5% plus capital appreciation on that portion of the portfolio. So that's a very brief summary of our outlook right now.
Great, thanks, Dennis. Any clarifying questions from us?
Thank you.
Any public comment? Great. So I'm going to accept this report. It's great, Dennis. Thanks. And I look forward to city staff being able to connect with you guys in a robust discussion in October.
Awesome. Thank you.
Take care.
Bye.
Bye-bye.
Fantastic. So our next item is another informational item, the Treasurer's Investment Report for June 30th, 2024. There's a staff report and all sorts of other good stuff. So I'll hand it over to you, Jonathan.
So, thank you. Today I'll be discussing the Treasurer's Investment Report for the quarter ending June 30th, 2024. I will briefly summarize the city's cash and investments before handing it off to Carlos with Chandler Asset Management, who will provide a more detailed analysis of these investments. This slide provides the general ledger balances by account. It has approximately 88 million in cash and cash equivalents, of which 22.8 million is from the operating checking account. And 65 million is located in light or local agency investment fund. So we have an additional 178 million in investments, of which 158.9 million is the Chandler, and 19 million is the PARS, which again is restricted to pension funds. Both investments follow the city California government code and their respective city investment policies. This next slide provides balances based off of the statements. You can see here, we have 175 million, and it is slightly different than what the general ledger, and that is due to timing differences. And those are oftentimes related to either outstanding checks or deposits and transfers in transit. Of the 275, we have $23.6 million in operating checking, 65 in late, 155 in Chandler, and 21.6 in PARS. Now, I do want to take the time to make a couple changes that have occurred since last quarter, or highlights. So working with Carlos with Chandler, the city to optimize the higher yields that we have right now while prioritizing safety and liquidity, we decided to shift or convert our general checking into a government advantage checking, which does provide the approximate 3% return. And now this follows the market. So as the market kind of starts shifting back to lower yields, depends on bonds, it's going to start decreasing that yield. And so and this is fully FDIC insured, so there is no risk to the city. Now, as we kind of move on over the next year or two, if this rate no longer makes sense for the city to keep it here, whether it's shifting it over to Lathe or maybe having Chandler invest it for us in a separate short-term investment, so it doesn't affect their overall strategy for the current investments, we're going to make that change. And a couple other things. So there was a couple transfers within the investment, 3 transfers within the investments. We ended up transferring about 2.4 million out of Lake and transferring into Chandler of about 8.6 million. So it had a net effect of 6.2 million coming out of the Wells Fargo. Additionally, we, as we discussed earlier, we transferred, I think it was 1.3, but if you factor in interest earned by PARS, we ended up transferring that out of PARS into the general checking. And that again follows that fiscal year 22-23 council approved transfer.
Maybe we can, in the interest of efficiency, ask questions, or do you?
Yeah, I'm almost done.
Okay, okay,
Let
no
me,
problem.
pass it off to Carlos. He'll quickly summarize.
Okay, okay.
And then lastly, for compliance, the city is in compliance of California government code and its investment policies. Additionally, the city has sufficient funds to meet expenditures for the next 6 months, following government code 53646. I will now hand it off to Carlos, the chairman, to present the investments in more detail.
Good afternoon, everybody. It's nice to see you guys. Let me get my light turned on here so we can see everything. I want to update you on the portfolio. I'm going to keep it as brief and high level as possible, and of course, leave it so we can give some time for you to ask questions. I want to update you on why the returns. You've gotten some very strong returns, and I want to let you know why that is and what we expect going forward. If it's okay, I'm going to share my screen, And the first thing that I have to do is, after I share my screen, is I have to apologize. While I was reviewing my materials, I noticed that there was an error. So I'm going to, wait a minute, that's the wrong one. I'm going to give you the update. I just went through and recalculated, and I'm going to give you good numbers so that you don't have bad data. What I'll do is I'll update you right now, and then I'll follow up with an updated version of the presentation. So here's what I want to do first of all. First and foremost, I think we all know that the portfolio itself has done quite well in this environment. Interest rates have been volatile, but generally a little lower than they were a year ago. They've been moving around somewhat. Fixed income has done quite well in the capital markets. That's primarily driven by just the status of the economy. I'm going to roll back and just look at the employment picture. That's part of the picture. What is happening in the economy is we're seeing a normalization in the employment market. We're seeing job generation trending a little lower, so it's not as hot as it has been. That heated labor market has been a big contribution to inflation, and one of the factors that the Federal Reserve has focused on in their decision to either lower the overnight lending rate between banks or keep it the same. So as a result, we've seen tighter financial conditions, higher interest rates, which for you has meant that the portfolio has continued to pick up very strong yields, and that's been driving the portfolio return. For the month of June, we generated 206,000 jobs. That's the chart on the left. But you can see the trend. That's really what I'm focused on, and it's been waning. Job creation has been waning, allowing the Fed to move towards a stance where they might lower interest rates sometime sooner. The unemployment rate edged up a little bit as well, which is good news for those of you that might be looking for lower rates, up to 4.1%. The other thing that I wanted to highlight is just with the inflation numbers. For the month of June, the year over year, I'm looking at the chart on the left-hand side and the dark green bar, or line, I should say. The year-over-year change in the consumer price index, which is a way that we measure inflation, came in at 3%. Compare that to the prior month at 3.3. And for the first month, the 1 month, month-over-month measure that we've seen since the end of the pandemic, we saw a negative print. The CPI actually declined over month 0.1%, which is good news. The Fed's preferred inflation measure on the right-hand side, personal consumption expenditures, where their target has been for the core inflation, where they remove food and energy, that gray dash bar, they want that to be at 2%. We're at 2.6. So we're nearly there. And so all of this amongst with a number of other things that I can point to, disappointing retail sales, a little bit lower than expected, and a slowing of GDP, which you can see it came in at 1.4. We expect growth for 2024 to be somewhere south of 2.3%. So all of this is leading us to believe, and most investors to believe, that the Federal Reserve is likely going to lower the Fed funds target rate, which is, this is the actual rate on the right-hand side. The target for this rate, the Fed is getting likely nearer to moving it lower. What does that mean for you? It means that reinvestment will be lower. Rates will fall. In fact, they've already fallen in the markets in anticipation of this happening sometime in September. So rates are just slightly lower from their tops. But obviously, when rates fall, the fair value of your portfolio goes up. So that's what we're looking at. We're thinking that the Federal Reserve is close to engineering a soft landing. That's yet to be seen, but it just means that they've kept rates higher, tighter financial conditions higher, long enough to slow inflation down, but not slow enough to put us into a deep or a hard contraction in the economy. And that's what they're trying to do. It's a balancing act. With that said, I'm going to, one last thing, the yield curve continues to be inverted. It just means that shorter maturities are paying you higher yields. This will start to go away when the Federal Reserve lowers rates. And as I said, likely to be closer in December. In terms of the portfolio itself, I'll let you look at the the statement of compliance, everything is within compliance. Everything follows California government code. I'm going to skip ahead and go to this page because I think it's very important. As of June 30th, we were managing $165 million on behalf of the city. The yield to maturity, or the yield that we would earn for the coming year, assuming nothing changes in this portfolio, was at almost 2.6, and we were reinvesting somewhere in the neighborhood of 4.75. The rating is averaging AA plus. It just depends on whether you look at Moody's and Fitch or S&P, but it's very highly rated. We've been maintaining a duration of somewhere around 1.8 years. Back in April of 2023, given some anticipated cash needs for the city, we were instructed to ratchet back the strategy. We try not to change that around too much unless there's a change in the city's circumstances, which is exactly what happened. So in order to be a little more conservative, staff decided that in case they needed the cash flow from this portfolio, they wanted to hold maturities a little closer, a little bit nearer, to have a little bit more accessibility. That worked out for you. That was actually a pretty good move. Now we're again at an inflection point. Since this report, some of the messaging, the instruction I got from staff is that because that cash need did not appear, we're free to go back to the old strategy, and it's not related in this report, but it will be in the next one, because we're just in the process of ramping up, and we do that gradually. We don't do that overnight. So just keep that in mind. The old strategy target was to maintain things somewhere around 1.8 years. As of June 30th, it was at 1.72, and we're going to be moving that back. The new target will be what the old strategy was, which was to be somewhere around 2.5 years. So do keep that in mind. Again, moving quickly through this, the bulk of the portfolio are U.S. Treasury securities, about a little bit over a third. We do that for liquidity purposes and safety. Corporates make up about 26%. We can go up to 30%. Notice we have more corporates and treasuries than we do in federal agency securities. Federal agency securities are very expensive right now. You're not getting very much value for the purchases. And then, of course, we buy a very well-diversified list of securities that are allowed by government code. We've got asset-backed securities, some credit card, and some auto loan structures, primarily auto loans and leases. We buy AAA rated World Bank bonds known as supranational entities. There's even some commercial mortgage-backed securities tied to multifamily housing, which are backed by Federal Home Loan Mortgage Corporation, Freddie Mac. We like those because of that backing. But in any case, you're very well diversified, and we count on that for the safety of this portfolio. I want to jump to the returns, which are right here. And I have to apologize. When I was reviewing all of this about an hour ago for just prepping for it, I noticed some errors. And I don't like having errors in my report, so I'm going to be republishing and sending it to you. But what I did is, between that an hour and now, I sat and I recalculated things here. So let me start by the first error, is that normally we show you a net of fees return. So I'm going to show you that in just a second. It's missing out of here. The second thing is that the benchmark, because the benchmark encompasses a period where there were two different strategies. As I mentioned earlier, we managed to a 1 to 5 year benchmark with a 2.5 year duration, and then the strategy shifted per staff to a 1.7, 1.8 year duration, and now it's in the process of shifting back, but we're not counting that in this report. But that dual period of the 1 to 5 and 1 to 3 was not captured in this benchmark number. So what I did is I went back and I recalculated it on the fly. And so I just want to show you the returns for the last 3 months. The return for the portfolio was 1.03%. If you start thinking in annualized terms, that's somewhere around 4.1, 4.2% annualized. For the last 12 months, ended June 30th, the return was 489. This is before fees, 489. I would tell you that about 3/4 of that number came from the higher yields you have been earning. And then I mentioned that yields are slightly lower than they were at the beginning of the year, which caused the portfolio to appreciate in value. So that's 489. When I factor in fees, that's a 482 versus the benchmark of 454. So you've done quite well given the amount of risk taken on in the portfolio. I would tell you, if you think about it from your financial statements perspective, if you think of your ACFR, your annually consolidated financial report that you issue every year, well, that 489 relates back to the interest income that is counted in your income statement. And then your staff also adjust that interest income that was earned. They adjust it for the change in value on paper from the beginning of the year to the end of the year. Well, that number encompasses all of that right there. It relates to 489. Again, 482 after we factor in the fee, when a benchmark of 454. Over the 2 years, that number, almost as good, but you have a period when interest rates were still low, so it encompasses that. It also encompasses a time period when interest rates rose, and in fact, the 3-year number encompasses when interest rates rose, which devalued the portfolio, and of course, yields were razor thin back then as well. They went from 0 to very high overnight, and it took time for the portfolio to reset. So you've got lower fees, but again, the portfolio solidly beating the benchmark, and so it's doing better than the market in which it is invested, and for the amount of risk taken on, it's done quite admirably. Since we began investing this for you back in 2019, we've been averaging 149 per year, taking compounding into effect, 1.42 when we factor in the fee, and versus the 1.38 from the benchmark. I would tell you that going forward, I'm gonna stop right there. But going forward, I think it's important to note. It's really important to watch and see what the Federal Reserve does. People are very glued on the September 19th meeting. It's important to note that a lot of the value in this portfolio has been driven by the non-governmental securities that we have in the portfolio, primarily corporates, asset backs, the mortgages, federal agencies for the small ones that we have. We don't have that much, and the Supras, of course. So anything that's a non-treasury, that's really driven. Normally when we get to a period when you have volatility, the prices for non-governmental securities tend to be more volatile, and for governmental securities, they tend to be steadier. And the yield differential kind of widens, showing greater amount of risk for corporates. That has not happened. The corporates have actually continued the amount of additional yield that they pay over a treasury, but their prices, if the treasury prices go up, the corporates have moved with it. So it's a very well diversified portfolio. We continue to talk to staff. At this stage, we're talking to you about every other week, just on audit related issues, not issues, just information, getting it for the auditor, on audit related questions, on strategy, on cash flow. It's a very dynamic process and a very dynamic program with a lot of staff involvement, making sure that things are headed in the way that they're supposed to. Let me stop there and take any questions that you may have.
Thanks, Carlos. Any questions from the other two of you?
Yes. So this is the investment policy issue that raised a lot of questions recently with all the transfer delays and so on, right? So I think in one of the charts, there was like a 23 million, the operating check.
Is this the PowerPoint presentation or or was it?
Maybe it's here as well.
I think it was the PowerPoint presentation. Go to the second one. But this one more.
Yeah, just maybe it's. So this is what has dramatically changed from the last, right?
So what the things what has changed that you really can't tell here is the operating checking account. So how the Wells Fargo treats it has shifted. It's the same account. It's just it now it generates a 3% yield net of any banking fees.
Right, and that's the new thing that you did.
Correct.
So that's a separate account?
No, it's the same account. It same account number. It's just how Wells Fargo treats it. So we don't. It wasn't a shift in accounting. It's the same statement. Now there's a little section on top of it of what that yield we would be receiving.
Okay, so instead of previously getting a 0%.
I wouldn't necessarily say it was 0%. Okay, so interest rate 0, in that the city wouldn't receive anything, but the way the account was created, it would get an earning credit. So depending on how much, what the balance was, that would kind of, it would decrease the bank. So there was I think it was a nominal amount, but it did cover the banking fees. So the city never had to pay for banking costs.
Okay.
And so I wouldn't necessarily say it didn't do anything, it's just that now it actually is generating a interest for the city, So I think it's about, what's 3% now, I think the fees is about 0.5%, or maybe a little less, but,
You still get about 2%.
yeah, so net, don't quote me on it, I need to go back and run the numbers, but.
If I may, this is Carlos. Jonathan, if the sweep vehicle was a governmental money market fund, which is I think what you opted to do.
We did not do the sweep, we ended up doing the government advantage.
That's
check.
that's a money market mutual fund, is that correct?
Yes.
So that governmental advantage should be paying you close to 5%.
This one's at 3% because it's fully FDIC insured. There will be.
Oh, yes, with the insurance.
Yeah,
Yes,
so that,
yes.
there's two ones that we were kind of going back and forth. The sweep would be 5%, but it would not be fully FDIC insured, so we decided to go, yeah, we'll get a little bit out of it, but to have that safety and liquidity.
We talked about the sweep account.
We did, previously we talked about the sweep account and we've been working with Wells Fargo. So they mentioned at this last conversation we were having with them that they had this other account available as well. So we decided to go with the account that already had about 3% interest that it's earning the.
And there's no impact on the liquidity.
Yeah. So this is just automatic. It calculates an average balance over the month, and then it applies a 3% rate, and that is again net of any banking fees. And so in reality, we'll probably get the high 2.7. It's not gonna be 3%, because again.
And how much does LAIF pay?
So right now they're closer to 5%. Carlos?
Closer to 4.5.
Okay, so it still makes sense to transfer into LAIF when and if possible.
Yeah, right now we have 65 million in there. And again, the cap is at 75. And so right now having the funds in case we will be making, there was some discussions about possibly purchasing a city hall. So we wanted to make sure that that was readily available. There was a few other discussions. So we haven't shifted those funds over to Chandler or anything of the sort. So there's still a few things that are in play before we start making shifts and larger dollar amounts. But as of right now, Lake is generating a decent yield, and it's quite safe, and it's very liquid. And so again, once we need those funds, we can transfer that out if need be. And so all our funds are creating something for the city at this point.
While we're still on that Wells Fargo account, I did see in the report, the staff report, that it was fully insured, and that was pretty amazing to me because I haven't encountered those kinds of things. I think your explanation here is, so I guess it's like a 2% cost basically somehow. That
Yeah, and our manager was Zena Bro, she was able to convince her supervisors to give us a 3%. She says she typically only sees 2.5%, and she was able to pull this one for a 3%. Because again, this type or that sweep account, which the sweep account does yield a bit higher, but it's not at fully FDIC insured. So she was able to give us a bit higher rate of return so that we would keep this type of account.
is there some limit on that FDIC? Like if you put 50 million in, you're not covered, or do they have a limit?
You know what, that wasn't brought up, so I'm assuming if whatever funds there are, they would probably give us some sort of error. We wouldn't be able to transfer those funds in, but we haven't gotten there. That's a good question. I'll bring it up to Zena.
Yeah.
And I'll get back to you on that.
Yeah, and Carlos, while we have you on the screen, are you seeing a lot of cities make this particular trade-off and this kind of choice, or what's your observation from all the various accounts you deal with?
Well, my observation is that the city staff's been a little bit more, they took a diversified approach to this, which I think is a wise approach. The reason I say that is because most cities simply leave it in LAIF. It is politically convenient. Even if the rates are lower, staff has taken the added approach of adding a sweep vehicle to your funds. So if it's rolling through there, it's still covering fees for the banking, but it's still getting paid a little bit of a higher return. So that interplay, it just demands observation. The nice thing is, it's like I said, it's diversified. You'd never know how long wells will live up to that deal. They could change it. Banks do often, although they are incented to keep it the way it is, or maybe even offer more if they can. So what I'm observing is this is a step ahead of your average city where they just simply leave it in LAIF or just leave it, just don't even think about it.
Great, thanks for that. It's always good to be a step ahead. I think you had a question or?
Question about staff report, but I don't think that would touch this.
It's okay, we'll keep Carlos here because we're not finished yet. Go ahead, go ask the staff question, and then we'll ask the public, and hopefully we'll have the questions or not.
Thank you, Mr. Chair. My question is very general. There's a lot of discussions about liquidity ratios. Those that's our base for making decisions as to how much you go into investment, how much you stay cash and cash equivalent. Is my assumption correct?
There's a lot of factors in how we, what we decide to hold on to as cash and cash equivalents and how much we decide to invest. And this is a discussion we constantly have with Carlos, to see, should we be depositing or providing more funds for investments? And what is our short-term and long-term need? So that's, as of late, it seems like we're kind of starting to get a clear idea as to what the cash needs will be for the city. But like I said earlier, so that what the government code states is we'll need to have at least 6 months worth of cash readily available. And we do have that with the short term, whether it's some of the funds that we have in Wells Fargo, late, and possibly money markets that even Chandler has, or also including that one year maturity or less. And that does cover those. But as we move along, I think probably in the next quarter, we'll have a better understanding of what kind of cash we want to have readily available and probably refine that process. And so those ratios may shift a bit for the better. So again, if whether we decide to hold on to it in one of our checking accounts or LAIFs, or decide to invest it.
Okay, so our target is 1 living ratio, but currently we're slightly higher to all reasons, the potential use. So in one of your chart, in a cash flow chart, you have a revenue and you have expenditure and you also have cash tax. So the revenue is part of the cash flow. Is that correct? Or it's not always the case?
The ratio would, it's the base would, or actually the numerator would be the same, the denominator would be different depending on the revenue. So the numerator, obviously the more revenues you have, the smaller your denominator would, or sorry, the more revenues you have, your ratio would actually decrease to 1, or the more cash you have in on hand, decreases or increases that ratio. So this, so by us having more cash, that ratio is moving away from 1. And so hopefully in the coming months, we're able to kind of pull that back in, assuming or have a plan for it, right? If we anticipate a large disbursement, then we would have to make that there's a reason why we would want that number higher than not. Or moving away from 1. Closer to.
Currently, when. Right, I understand that. I told you.
Yeah, sorry, it gets a bit complicated, and then a lot of it is, there's still some moving parts with the city, so we don't want to lock our cash up for a few months, for a couple years, 3, 4, 5 years, and not and have to take a hit by selling an investment.
So all this, what you just explained, like the anticipated expenditure versus revenue, and this base cash flow, and there's also anticipated. Is it documented somewhere? For the public to read and understand without asking you, without.
I don't believe we've documented any specific place where
The capital analysis or cash flow, documentations.
we do have a cash flow log that we're able to, from these, that's how we calculate these amount of these ratios. As far as, having a long-term forecast, I think part of it is kind of built into the budget, kind of knowing what's to come. And we are in development of a more refined cash flow, maybe kind of considering on a weekly basis, which is something the city hasn't done to that granular level. And so over time, we'll be able to pull in the transactions that this is, I think it's gonna take about a year for us to truly refine this process. And this will kind of give us an idea, like that rolling 6 months or rolling year ratios, or whether it's short term, long term, or if you want to take it into several years, what we're going to be shooting for as far as cash balances, and also factoring in CIP or any other disbursements or purchases. And
So that's really fun. All right, thank you.
And I think, Carlos, when you first came on, there was a massive project to look at cash flow projections, and that's maybe 5 years ago. So I understand maybe from the staff report, you updated it for major expected changes.
That's correct. Staff, there was a point in time when staff identified a very strong need for cash, and it was a big unknown for quite a while. That was a multi-year endeavor, not the calculation, the actual does the cash need to spend this money or not? There was a waiting period of almost 24 months or somewhere around that. That had a big impact on how the monies were to be managed. And so the prudent thing was, if it's a large cash flow that would significantly impact the city's reserves, the prudent thing to do is to start ratcheting your durations back, such that if you needed more cash than what is available from revenues and from cash overnight in LAIF and also in the bank, if you needed to liquidate from this portfolio or rely on maturities that came from this portfolio, you would be able to do so with minimal losses, or no losses at all if possible, with maturities. So as a result, based on a conversation with staff a few years ago, and with my consultation and advice, we ratcheted the duration target back, and that was the big driver. In terms of cash flow, one of the things that we did is we worked with staff to do a statistical cash flow analysis, but it's not nearly as good as some of the budgetary analyses that staff does on behalf of the city. That particular cash need that I mentioned, the large one, it's been communicated to me that it's gone away, and because of that, the large outflows are not anticipated. And the city staff decided that it was best, now that we don't need that they don't need that cash, that they revert back to the old strategy that emphasized longer duration maturities, which, not that we try to time the markets, we're not market timers, but from a timing perspective, the beginning of moving towards that longer duration target will actually be beneficial for the city if interest rates indeed drop. So that's kind of that's the story behind the story there,
Yeah, much appreciate your clarification there. And I just want to thank you for putting the net of fees in your adjustment there. You know, that was a little bone in my side for years. So it's exciting to see you put it up proactively. It was on my sheet for a question, so I'm not going to forget it, but I appreciate you putting it up there. Well, I think it's a great 1.42 is way over the benchmark. So it's another very nice story to tell. In addition to all the great services you provide, we get a higher yield than the benchmark. So that's exactly what everyone wanted. Okay, we've clarified enough probably now. Are there any public people that have shown up? No, I see a no. So I get the pleasure of accepting all these reports. Thanks everybody, all your participation. There's a lot of effort to put these. I can remember when the treasurer's report was 6 pages or less, and it's doubled in complexity, I think, as well as informative. So thanks, everybody. Okay, we'll let you go, Carlos.
Thank you, everyone. Good night.
Thank you.
Thank you.
Carlos.
So we accepted those, and that brings us to the last informational item, which is our work plan.
So, we moved a couple items from today's regular meeting, onto the October regular meeting, including the Moss Adams citywide policy and the AUPs. We've received the, as Colleen stated earlier, they've provided us with a draft for the process of reviewing, so that will be ready for y'all's review, in October. Same thing with the AUPs, we've gotten, the GAN limit, and actually as of last week, I believe we received the drafts of the other AUPs. So we'll be reviewing those and bringing them to, the committee for your review, from October. Additionally, we're in discussion with, the fund group to include an additional AUP, which is a credit card, review. So they'll be reviewing credit card transactions and make sure it follows the city's credit card policy. Historically, that AUP has been included in the policy, but as we were reviewing that policy, refining that this last year, we noticed that language was in there, that there should be an AUP relating to that. So we started that discussion with them, and we're going to keep that language in there so that there's more transparency related to credit card use. Additionally, in October, we will also be providing you with an ACFR update. So just to inform you what the status of it is, which we will tentatively, once we're able to confirm everybody's schedules, either December 6th or the week of the 9th, to review the ACFR. And we'll also be including the budget format review, which will lend well for the budget process that's I guess at that point starting to ramp up.
From my perspective, both of those meetings look like they're gonna be very busy. So we'll do our homework beforehand, I'm sure. Make it as efficient as possible, but you never know. Sometimes they're complex issues, and when we get new things, and everyone should have to do discussion. That's part of our deliberation. So sometimes when it'd be nice to somehow, like today, it works out because we got to go for other meetings, but it'd be nice if we could balance this somehow. And I sure don't know how over the years, but the whole budget thing, maybe that will likely shrink if my experience tells me anything. So we should not, maybe we can follow into January or something if we have to, or whatever the following meeting.
I think last year's delay jammed everything. Right, and assuming if they stick to the schedule of having a draft by December.
Yeah, so I think because of the delay in the act, we're kind of push out the AUPs. So come next year, the AUPs should be presented likely in March. So that we won't have this heavy workload later in the year. So this year it has been challenging. Yeah, I think it is a one.
So when council reviewed the ACFR last, you said that you'd be providing these AUPs at a later date.
Correct.
Right.
So once you review
Which ones are we
these,
talking about?
so that's the October 28th, you'll see the AUP for the GAN limit, investment policy, and storm drain. Again, that's for fiscal year 22-23.
So that's two different.
There's three different ones. So
Oh,
the GAN
there's three.
limit, investment policy, and then storm drain.
Okay.
And we'll talk about the credit card one, provide input to maybe for the 2024 fiscal year.
And so for the 23-24 audit year, you would have an opportunity to review those processes or the procedures and make recommendations, to which we would pass along to the auditor and have them include that in the 23-24 year.
So these AUPs then that we will review in October pertain to,
20.
And there will be input to, because we've already passed, amazingly enough, fiscal 2024. So all these three and maybe the credit card one comes into last month's ending year. And then usually we'll be giving input at the same time for the following year, because that's, at some point, we won't have to tackle that. There's no way we'll have time for that one, but.
right, so these AUPs then go to council?
It is just a receiving file. There's really there's no action required on your behalf. We can probably speak with the city clerk's office and see if this can just be an informative item, so that it doesn't need to be, but then, the politics of these
Yeah, right,
reports.
because, yeah, already it just will be so outdated.
I think that the hot topic, if nothing comes out of this, if it's a clean report, I don't see a overwhelming need for October to actually bring it to council directly.
So you haven't seen it?
We have the drafts, yeah.
Does it look like it's gonna be a clean?
For the most part, yes. There's a small, like $1,000 difference in the investment policy or investment how we report it out, but there was I don't think that's material. There's certainly nothing material. Let's put it that way.
All right.
And that's actually, you raise a great point. Something agreed upon procedures is a very specific subset of what external auditors can do. And having been one, retired now, and we don't have the defense people here, but they're, the procedures are defined by either the audit committee, city council, or in this case, most likely city staff, because nobody's been defining those. So it's kind of only worth how good your definition is of the agreed upon procedures. So don't be expecting anything exciting. It's my observation.
Yeah. And we carried over for the most part what was provided in the past.
Right.
So if there was
Sure.
a need or a huge change, I think that would have been touched on last year. And so I think if once you see these reports and you decide you want a slightly different, or if it's too expensive, that can also dial it back some, because it's also very time consuming for staff. But that's entirely up to you to make those recommendations.
Okay, we'll open the door. Now we can talk, well, I'll keep this brief, but on the investment policy, that's the only one that I find really interesting. And over the years, I've tried to eliminate that AUP. And I failed miserably. The external auditors came back and said, well, we can't do anything else other than AUP. That's all we can do. If we issue an audit, of course, that's going to be very expensive. And so I was trying to find alternatives to it. So since there's another 3 months before that happens, maybe you guys will be able to talk to PUN and say, is there an alternative? Because I'm not sure we're getting a lot of value. It's in the investment policy, which we as a committee will look at in October, and then city council will approve it. And in there is where that AUP comes about.
And maybe it's how you're conducting the procedures. And so what you're looking at transactions, do they follow the policy?
There's an internal audit function now that can easily do that. We don't have to be relying on the external auditors to do a specific set of procedures. You could cycle in and do an internal audit program once every couple years or something. That might be more valuable, right? Yeah, okay. I know we got to go or want to go. So I accepted whatever I needed to accept on this. There's no other discussion.
Can I have
Oh,
one clarification?
Yeah.
What date is the September meeting? You mentioned every Mondays, but 9th, 16th, or
There's nothing in
September?
of every December, I'm sorry.
Yeah, so we're still, I think
We're still
we were thinking the 16th, but I'm starting to get some feedback that 16th may not work for some. So as we continue to get feedback, we'll find the best date. We were shooting for the 16th or the week of the 9th. So as we get feedback, we'll find a date that works for all, if not most of you.
When is the city hall code?
At the following week.
23rd. I know it can be 16th, and we're going to guess.
The 9th or 16th, I think, worked for me. The issue being ideally the aquifer is at the point where it's pretty much finished.
Yeah.
If we get one of these, we've had that problem where we'll put this special date and then of course fund group or whatever, external factors arise and you can't really get it. So I'd almost canceling the meeting, but that's very political. So you guys are in charge, but ideally we'd like to have it as far along as possible. Okay, I did want to quickly, as we've got other things on our agenda, we got another half hour to go. No, I'm just joking.
You're good, you're good.
There's something about future agenda setting, and I'm not interested in that so much. Once we're already doing that with the work plan, but
Right.
we did have I attended the mayor's commissioners meeting on July 17th, and as in the past, but this one was particularly informative, and there were 3 dates that come up that I learned about. So I wondered, Angela maybe or Hanya would be, maybe you know, but I'm sure Councilmember Way and the mayor know already, but September 4th, I'm working already with city staff to give the audit commission presentation for 10 minutes or less. So that's well in hand, but if anybody has input, feel free to shoot it to city staff and they will put it on my agenda with them. November 16th then is a more important one, almost in many ways. It's the Saturday evening Cupertino Community Service Awards, the new name for a combo event of commissioners and crest awards. So if you don't have that on your calendar, which I didn't, it's good to do. It's great for incoming and outgoing commissioners. So as you remember, those things happen. And then September 18th, I'm going to be out of town. That's the next mayor's commissioner meeting. And I think there was some in-person event here at Quinlan. So I don't know if Angela or the mayor wants to represent herself, but it's probably better if we get somebody.
At the commissioners meeting?
Yeah, I think that's the date. I happen to be on a plane that day, so
Okay.
otherwise,
Angela, if you want to, that's fine, but it's
September 8th.
if we're not to, then I'll be there.
September 18th.
September 18th at 5 o'clock.
I'm gonna, yeah. Let me check what's good. That's the that's a Wednesday. What time?
5 to 6:30.
I just fine. They just have a district meeting at 7. Okay. Bye. Thank you. Yeah.
great. Angela will be doing that unless it's changed. All right, on that happy note, we are adjourned. Thanks, everybody.
Thank you.
Public knowledge that this